In the longer term, when we look at oil demand, the EV adoption in China was, I knew it was accelerating, but some of the charts that I saw were the clear drop in conventional car sales, in new car sales, and the hockey stick increase in the EV sales was quite remarkable.
And now with BYD's latest announcement of 5-minute charge to get 400 miles, I mean, just don't underestimate.
I've heard a lot of different pundits call China the green dragon because of how quickly they're going through the energy transition and how quick their build out is. For those of you who don't know, 85% of the solar supply chain is actually based in China. And recently our colleagues over in BNEF put out a report saying that a lot of the installs last year, in the top 10, 3 of the top 10 manufacturers are actually Chinese names, surpassing names like Vestas, Nordex, GE, and Siemens Energy.
So one thing about steel is it's not widely traded in futures land, but copper is the doctor, and there's a significant disparity between U.S. traded, CME traded copper, which is pumping up around $5 a pound. It's up 25% in a year, and LME traded London-based copper, which is the disparity between those two is the highest ever, and that goes back about 30 years in futures. So that's unsustainable. It's going to be reversed. Typically, it's a sign of demand pull when copper goes up, and we all know it's not. It's a disparity because of tariffs.
I think the deflation that you're talking about there in liquid fuels, Mike, has really unfolded in a big way in the solar space. So if you look over the last 18, 24 months, we've seen a big retreat in polysilicon prices, which is key input for making solar panels, and we've seen module prices follow down as well. Challenging environment for some of the companies that make modules, that sort of thing, but certainly great news for consumers because they get lower cost, higher quality modules. Good morning, good afternoon, everyone. This is Rob Barnett joining you today from an undisclosed location in Greater Miami area, only about a mile from Mike McGlone, who's also on the call at Bloomberg's lovely office here. And then swinging over to Dubai, we've got Salih Yilmaz joining from his usual perch there. He's just back from a week-long marketing trip in Asia, so I'm curious to get his readout from that. And then swinging over to London, we've got Alessio Mastrandrea joining us to talk about some recent work we've been doing on the clean tech space. So, Salih, let's come over to you. Just looking at Brent here at the moment, about $70 a barrel. I'm curious, what was the vibe like as you were traveling around Asia, speaking to clients? What kind of things were you hearing? What's the pulse of the market, given you've been out there in the field this past week?
Sure. Thanks, Rob. Great to see all of you, and great to be back in Dubai. So it was a very fruitful and very interesting trip in China. We were in Beijing meeting some of our clients, and the general tone I thought was pretty bearish. I think there doesn't seem to be a lot of hype around recovery for oil demand. That's both for China, but of course globally as well. And we did hit all the 3 barrels, as they call them, 3 major Chinese oil and gas companies, CNOOC, PetroChina, and Unipec. And generally from the vibe I got was generally people agreeing that there is currently just a lot of pressure on oil prices right now. And some of the, I'll try to keep this brief, but I thought some of the slides shared by our colleagues in our Asian offices were quite interesting. In the longer term, when we look at oil demand, the EV adoption in China was, I knew it was accelerating, but some of the charts that I saw were the clear drop in conventional car sales, in new car sales, and the hockey stick increase in the EV sales was quite remarkable. And looking at a little bit shorter term, some of the indicators that they seem to be watching very closely, like the China oil imports down sharply in January and February. I think this was also partly driven by the sanctions and perhaps Trump coming back into office, and some of the traders maybe being a little bit more cautious in trading. some oil, including in China. But they seem to be watching the private refiners' run rates, which, I mean, these tend to be the marginal producers, and the utilization rates there are apparently running at less than 50%, which is not a great indicator for oil demand. Oil tanker rates going from the Middle East to Asia, to China, also down, again, probably partly driven by sanctions, but also generally not a great indicator for demand. And China PPI, that's been negative for a while now, is seen to be a negative indicator as well. So generally, what we heard is both in the short term and in the long term, nobody really seems to expect a major recovery in the oil demand picture in China.
Let's switch fuels though. What about gas? Was gas and LNG a big part of thinking, or were you mainly focused on liquids?
We mostly focused on liquids, but I think gas is going to be a lot more important. I think the country is trying to be self-sufficient as quickly as possible, and I think LNG is a big part of it. But also, I think, just reading the question in the chat. Yeah, so we haven't really talked about gas that much, but it seems like they're looking at gas a lot more for their energy mix as well. And just the new nuclear power, nuclear is obviously going to be a lot more important for their energy mix going forward as well. And we had a couple of slides on that too. But yeah, the general focus was on oil.
Very interesting. I know you don't look at the coal side of the story, but I think I saw a stat that's something like in the last 5 to 10 years, China has burned as much coal as the West did over the prior century, right? And so clearly a big, voracious appetite for energy in the region.
Absolutely. And there was one slide on how the coal inventories in China have been on the rise recently, and they were saying that this is generally not a good indicator for the energy demand in the country. I mean, I don't really know if there's a direct link with oil necessarily, but they were showing that the wider energy demand in China isn't really doing so well in the recent months either.
What a contrast from America. We're actually on a growth trajectory, particularly in the power sector. Okay, this is a good opportunity to bring in Mike McGlone. I feel like Salih's singing a little bit of your narrative here that you've been banging the drum on for a while now. But what do you make of Salih's comments? And just checking in again, Brent about at 70 a barrel, but what do you make of where we're at and where we may be headed, Mike?
Well, I think Salih did a good job of describing the global macro factor of bearishness in crude oil on the back of high prices. What we're proving, and he nailed the technology, and the question in the chat nailed the question. I'll mention that in a second. Is the technology is happening so fast now you can't keep up. Drilling technology, increasing supply, which is part of it. Ethanol in the Midwest. And on the demand side, it's crushing demand. I mean, it's a perfect storm for lower prices. And so I want to mention one quote I've seen from Anna Wong. She's our chief economist. I have to mention her today because the Fed's going to be speaking in today, and she thinks they'll be hawkish, which is bad for most risk assets. And we know where crude oil fits in there. But her quote, and she tweeted today, X'd. Most interesting thing I learned in my Houston tour was that Bessett's 3 million barrel pillar is likely to be achieved when it includes crude, liquids, and gas, which is Bessett's intent. But I also heard that was going to happen regardless of Trump policies. Exactly. So what I really appreciate is people who are not in the weeds like we are. We've been pointing this out for years. This is the trend. This is the trajectory. What stops it? Now we have a motivated president and administration that wants lower energy prices, and they're going to get it. The question is, how much lower does it go? So I like to point out in the chat, there was a question about the average internal combustion vehicle is 12 years old in the U.S. My electric car is 11 years old. It's a Chevy plug-in hybrid, and the power loss from the battery has maybe been 10%. That's been 11 years. So the technology is overwhelming. And now with BYD's latest announcement of 5-minute charge to get 400 miles, I mean, just don't underestimate. So I think this is part of the perfect storm for what's happening in all commodities. I see it in grains, massive production coming out of Brazil, biggest supply ever in soybeans. Why? Because the technology is kicking in, and maybe less so in the metals, but particularly in crude oil. So I'll probably be rehashing the thing I published last year in November, that we're more likely to see gasoline prices in this country drop to $2 per gallon. Right now, about $3, because it's always done that. Been 20 years of data. We always drop to 2 as we get too high. We have an excess of supply. We have to export gasoline and crude oil and LNG and liquid fuels. We have excess. Sure, there's a little discombobulation with Canada, but I don't see what stops it. I think that we're just gravitating towards the marginal cost of production in the U.S., which is not profound. That's $56 a barrel for WTI crude based on Bloomberg New Energy Finance. But to really shut that off, you basically have to get down to around 40. It's not profound. That's what we've done for the last 20 years. You bottom there 40 after you go 100. It's the cycle right now what stops it. So a key thing I keep watching is managed money net positions. When you get stuck in a range, it's what the traders are doing. And they're still elevated long. Remember last year when we bottomed around 66, managed money net petroleum positions got short for the first time ever. Okay, and then we pop back up. The high's been 80 in WTI. And now we're heading back down and they're still long. So see the cycle there, like Salih said, you need some kind of shocker. Otherwise, any type of bounce should go higher. And here's the key thing I want to end with. Now we're getting people like Gina Martin-Adams, our chief equity strategist, who's been bullish the stock market for spot on for 7-8 years, getting bearish, pointing out we can drop another total 20% in the S&P 500 and still just getting back to normalization. That means deflationary forces reciprocal to the inflation, which is all the lessons of history point we're heading there. And you mentioned China's well ahead of the game. It looks to me like, I traded JGBs back in the 90s, and I've seen this before. Chinese 10-year note yield of 188 means deflation. We're all heading that way.
Okay, this is a good opportunity to bring on Alessio. So I think the deflation that you're talking about there in liquid fuels, Mike, has really unfolded in a big way in the solar space. So if you look over the last 18, 24 months, we've seen a big retreat in polysilicon prices, which is key input for making solar panels. And we've seen module prices follow down as well. Challenging environment for some of the companies that make modules, that sort of thing, but certainly great news for consumers because they get lower cost, higher quality modules is basically the effective outcome for consumers. But Alessio, I'm curious, Salih talked about a lot of appetite for energy in China, though potentially slowing. What's going on with solar and wind in China in that market?
Yeah, so thanks, Rob. I've heard a lot of different pundits call China the green dragon because of how quickly they're going through the energy transition and how quick their build out is. For those of you who don't know, 85% of the solar supply chain is actually based in China. And recently our colleagues over in BNEF put out a report saying that a lot of the installs last year in the top 10, 3 of the top 10 manufacturers are actually Chinese names, surpassing names like Vestas, Nordex, GE, and Siemens Energy. As Rob was kind of alluding to before, solar prices for modules have fallen to about 9 cents a watt. Just by comparison, that's the price in China. In the US, companies like First Solar are selling for 30 cents a watt. So there's a big discrepancy there. And these companies are kind of cannibalizing each other to see who can kind of get to the race to the bottom fastest, but they're seeing margins get cannibalized as a result. So I believe that this year is kind of where we're going to be seeing a bit of a reset, but demand is still going to keep going faster and faster in China.
So let's noodle on that idea a little bit more. So the reason that solar panels are priced at 9 cents a watt in China and really most of the globe and closer to 30 cents a watt in the US has to do with trade policy. And trade policy's been all over the news. And I'm curious, Salih, when you were in Asia this past week, were folks concerned about the heightened trade tensions? Was this a big theme, or is it something that they're shrugging about over there?
Oh, for sure. I think tariffs and what it means for global trade is one of the major overhangs for oil prices. I mean, I think there are quite a few drivers, and I think the most dominant factor seems to be Trump's general preference for oil prices. As Mike alluded to, I think the administration wants to get lower oil prices, and they will continue to push to get lower oil prices. And I think one of the major drivers have certainly been the tariffs, which people were. It was one of the themes in some of the meetings that we had. But perhaps the concern is not the current tariffs, but the risk of the retaliatory cycle and the risk of widening trade wars, which obviously would have a significant impact on oil demand and on oil prices. And I would just say one thing. Another headline that we saw earlier on the terminal was, I don't think it's necessarily just any region that's concerned about tariffs. I think the big oil company CEOs are meeting with the Trump administration later today. And I think they're going to thank the administration for how supportive they've been for the sector. But also, I think there seems to be a lot of concern around, one, tariffs and what it means for oil prices, and two, as I mentioned, the administration saying that, I think one thing that's come up is that they want to push oil prices down to $50 a barrel. I don't know if this is really what they're pushing for, but even if it's higher than $50 a barrel, really pushing prices down is not good for the business of these companies. So clearly a lot of concern around tariffs and trade wars, and perhaps oil prices going down too much.
Mike, I want to get your perspective on how trade may be influencing the market. One of the commodities that Alessio and I spend a little bit of time thinking about is steel. And if you look at the US steel price, you see it kind of bouncing along, and then the tariff thing kicks off and you see a pretty big spike, which is a challenge for the wind names because they use a lot of steel in their process for making the turbines and towers. So how are you thinking about trade and tariffs and that kind of thing playing into the general commodity landscape?
Copper. I have to start there. So one thing about steel is it's not widely traded in futures land, but copper is the doctor, and there's a significant disparity between U.S. traded, CME traded copper, which is pumping up around $5 a pound. It's up 25% in a year, and LME traded London-based copper, which is the disparity between those two is the highest ever, and that goes back about 30 years in futures. So that's unsustainable. It's going to be reversed. Typically, it's a sign of demand pull when copper goes up, and we all know it's not. It's a disparity because of tariffs. So it's a question of, to me, when that reverts. And so far, it's been proving me wrong. It keeps going up. So that's the key area. But in the big picture macro for tariffs, I got to give you what I've learned in my almost 4 decades in this business. A quote I used to use, and thing I used to say with clients 30 years ago when I was a trading pits is, everybody in the world wants free trade as long as they can run a surplus with the U.S. That's being shut off. That's what Robert Lighthizer book, the No Trade is Free, is pointing out. And Trump wrote about this thing and talked about these things decades ago when I was in the trading pits saying the same thing. So this is what's being reversed, is the dependency on exporting to the U.S. in any way, shape, or form. It's just over. Sure, there's going to be discombobulation in the meantime, but that means, to me, this is part of the trigger that was way overdue to kind of eliminate a little bit of U.S. exceptionalism. It's happening. And that part of that is the stock market going down, which means all assets go lower, which means deflation. So here's the facts about tariffs. The U.S. right now, our total, the last 12-month measure of our trade deficit is about $1.2 trillion. It's pumped up because of the anticipation and the front running and everything. Now that's guaranteed to go down. If it doesn't, Trump's going to just hit it harder. And what does that mean? Is all those people exporting to the U.S. will not be able to do that anymore. It's stopping. But I like to point out, okay, so maybe 20% of that is $200 billion. It's in somewhat inflationary. It's a 1 on a scale 1 to 10. You know what the 10 is? Just what's happened in the stock market this year. So far, it's dropped about $3 trillion. That's 10% of GDP. That's only 10%. Anna Wong says we're going to drop another 10%. That's 20%. That's severe deflation because of tariffs. Just shifting what's been happening and what's been driving the U.S. stock market forever is, U.S. companies importing to offset costs, and massive fiscal stimulus. Fiscal stimulus is being shut off. Monetary stimulus is shut off for now, and tariffs are kicking in. To me, this is a almost a perfect storm for lower asset prices, and crude oil is kind of leading the way.
Thanks, Mike. We've got a cool chart out this morning from a note we published that looks at the steel, and that divergence you just described in copper, same deal, right? So US steel spiking up, European steel, flattish, trending down.
Right.
So Alessio, tell us a little bit about the note and remind everyone the last time we had a big spike in steel prices, what happened to the wind names?
Sure. So back in 2022, we were seeing supply chain constraints for European steel, and we saw turbine manufacturers lift turbine prices from about 80 cents per watt to over $1. And so I believe that we're in the middle of a bit of a juxtaposition between US and European wind names. Vestas and Nordex just had record order intake values in 2024. GE, not so much. They said they're likely going to be flat through 2028. I think the fact that steel is now cheaper in Europe versus the US might actually hurt them in the long run as far as competition goes. I think despite the fact that Vestas opened up a new offices in the US, they're going to likely shift their focus to Europe where they can have a bit of a competitive edge, but still keep turbine prices slightly elevated.
Okay, thanks, Alessio. Just real quick for everyone listening, in the chat, you'll see that Salih has posted a link for a survey that we're currently conducting. And I believe today is going to be the last day, maybe within the next 24 hours, we're going to shut it down, and then we will be sharing the results on the terminal. But we're doing all kinds of questions on, expectations for oil prices, thoughts on OPEC policy, thoughts on peak oil demand, and on down the line. So we're very curious to hear kind of from practitioners out in the field, kind of how you're reading some of these big questions about the market. So with that, with a couple more minutes that we have left, Salih, I want to circle back around and just get your general sense now that we've got full year results out. We won't be too long before we're kicking into the 1Q season, but give us a sense. How do you read the tea leaves? How is the oil patch faring in your part of the world?
Sure. I mean, when we talk about this part of the world, of course, we generally talk about Saudi Aramco, partly because of the sheer size of it, and partly because it is the only listed NOC. I mean, of course, ADNOC has listed some of its subsidiaries, but Saudi Aramco is the only one that's listed the whole company. And I mean, their results have been okay. I mean, there wasn't really any huge surprises in the 4Q results. Operationally, it's been just as expected. But their share price has actually hit a 5-year low just yesterday. And I think the outlook is not really being helped by the fact that, one, their output has been stuck at just below 9 million barrels per day. And that's, of course, due to the OPEC plus output cuts, the implied quotas that the company is essentially given. And just to put that in context, their actual capacity for production is over 11 million barrels per day. So they are producing at a level more than 2 million barrels per day lower than their actual capacity. And two, when we look at the outlook for OPEC plus, I mean, as you know, a couple of weeks ago, they announced that they will proceed with the output cuts, the output hike in April. So of course, this will mean Aramco will be able to gradually increase its output, which is good, but it will probably come at the same with lower benchmark pricing. So both being limiting factors for their revenue generation, I don't think investors are liking this at all. And the other one, of course, last couple of years, Aramco was paying a massive performance-linked special dividend that's essentially coming to an end this year. So they're going from about $124 billion in total dividend payments to about $85 billion, which is still a lot, but it's a big drop in total dividend payment. So that's generally Aramco. I mean, you can argue that this is a pretty special case in the way that they're part of the OPEC plus cuts, and they're responsible for the totality of Saudi Arabian crude oil production. But for the wider group, when we look at this year, we have benchmark prices, I mean, Brent at about $70 a barrel, and that's despite the increased geopolitical tensions that we saw in the last couple of days. And I think generally, going back to what we were talking about earlier, there is a lot of pressure, and there will continue to be a lot of pressure, I think, on prices throughout this year. So at a very top level, you know, I don't think they're going to be getting much help from pricing. And in the case of Aramco, maybe they will be able to increase their output just slightly. That's probably not going to be enough to compensate that lower benchmark pricing. So generally, you know, the outlook is really being hurt by the outlook for oil prices.
Okay, thank you. Alessio, I'm curious as well to get your read on some of the companies in the clean energy space. You know, Mike struck a pretty bearish tone on the overall market. But when I look at some of the names in the solar space, First Solar, company that we've got a focus idea on, you know, they're currently trading at 4.4 EV EBITDA, quite low relative to solar peers, quite low to its own history. Vestas, which you mentioned just a few moments ago, trading for 6.4x on an EV EBITDA basis. Nordex also sub 7. So, you know, what do you make of the way that the market seems to be viewing the wind and solar names right now?
Sure. So we started doing this EV/EBITDA analysis on our theme baskets, and we were generally comparing to the Bloomberg World Index and the S&P 500. And at least back then, wind and solar names were trading at least in line or above those indices. And just for reference, the Bloomberg World Index is currently trading at about 12x EV/EBITDA multiple. So they've fallen quite a bit. And I believe a lot of that is on just the political uncertainty going on, specifically in the US. If you look at Europe, Germany just announced their $500 billion fund. 100 billion of that, excuse me, is going to be earmarked for clean energy and transport.
All right, that sounds good. Yeah. Generally speaking, fundamentals are pretty strong for the wind and solar names, and the you know, even with some of the macro uncertainty, I still think these are probably growth businesses for some duration still. Generally speaking, we've seen rapid, you know, 20%, 30% plus growth rates for the industry. I think solar demand CAGR for the last 5 years is roughly 30%, right? So very fast growing industry. Mike, let's come over to you for last word. So sounds like we've got some complicated fundamentals in the market, some complicated macro in the market. So, you know, what do you make of all this? How do you survive 2025 given some of the things folks have said on the call here?
It's the simplest thing, but sometimes the hardest things in markets. Just lighten up on risk assets. And I find everybody's looking for alternatives. Just don't overweight. And what happens when you get up this far, this much, it's only the last time we got this expensive in the stock market versus GDP was 100 years ago. I'm only 60, so I consider myself kind of a pup in terms of that experience. You just lighten up, and it's just getting started. So China's a good example. Their stock market's going up because of massive fiscal monetary stimulus. That's what happened in Japan, and Japan 30 years ago finally caught up. The U.S. is just catching up. So I think the key thing I'm pointing out is I fully expect gold to continue outperforming most all assets. It's been almost 4 years now, 1, 2, 3, and 4 years is beating the AI-driven U.S. stock market. The thing is, gold at $3,000 an ounce is expensive if the stock market keeps going up. So you see the tilt there, it's more of a stock market put. So I see one of the key things that still sticks out to me as a sore thumb is U.S. Treasury yields, long bonds at the 10-year to 430 versus 188 in China. There's seen some divergence there. European yields going up, U.S. yields going down. To me, the key thing is when we get more of a correction, U.S. stock market, which is somewhat of a base case of the Trump administration, they understand what's needed to get the Fed to ease, to get deflation or inflation lower, to get oil prices lower, to get mortgage rates lower, the stock market has to go down. So to me, that's just time. And I think what we're going to see for most of this year, selling rallies and risk assets, and maybe buying dips and risk off assets, which means gold and bonds. The key thing I'm really watching closely is cryptos. I mean, the best indications for excesses in this space. And it looks like we had a pretty, to me, the peak in Bitcoin at 100,000 is very similar to the NASDAQ composite at 5,000 in 2000. Very similar. And so I'll end with this. We still have people who think that Bitcoin's digital gold, and I like to point out it's got a much higher correlation to Dogecoin, which is a joke, and still has $25 billion of market cap. You can lop 3 zeros off of that, and it's still too expensive. So we just need to purge some more of these excesses, and that's normal, and that's good, and Bessent has even pointed it out. And just a question of nadars, and typically those aren't as easy.
All right, Mike. Thank you so much. I hope everyone is having a great week, and we hold these calls every Wednesday at 10 a.m. East Coast time, and so we hope you join us next week.